Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we're talking China and oil. How has their oil sector developed over the last 50 years? Who are the teapot refiners? And how is the market now structured in the wake of COVID, sanctions, and the EV revolution? And how consequential is China now to global crude pricing and market dynamics? Our guest is Tom Reed, Vice President of China Crude and Products at Argus Media, the independent price reporting agency, and Tom has spent a career watching China, understanding the details from this very opaque sector. As always, you can really support the show by leaving a positive review on the platform you're listening on. And as always, I hope you enjoyed the episode. Tom, welcome to the show.
Thank you very much, Paul. It's a delight to be here.
I've been looking forward to this discussion because it's frankly an area, it's quite far away from, I guess, my career being more sort of Western Hemisphere. But we're talking about China oil demand and where it was, where it is today, and what the future might hold. And obviously, it's a very consequential story for oil itself, but also the broader energy markets. Can you help set the scene for us, maybe going back the last decade and kind of tell us how, the China oil story and how we kind of got to the point of just before COVID?
Yeah.
No,
I mean, it's a lot to unpack because for many, I think China is the black box in the oil industry. It's the second largest oil market in the world after the United States. And it's very poorly understood outside China, I think it's fair to say. But it is important to say that, it follows rational rules. These are rational actors. And the ways that we see China impacting on the global market make perfect sense so long as you understand kind of what's going on behind the scenes. So I guess maybe a good way of doing this would be to go right back to the start and just say, how did we get to the point where we are now? Because also what China did in its energy sector was symbolic of what we see happening in other parts of its economy now. And when I say back, I'm going to go right back to the Korean War.
Fantastic.
Because at that point, China didn't have an oil industry. It was only starting to industrialize under Mao Zedong. And basically, people burned coal for heat. And there wasn't an oil industry. There were some imports, but then the Korean War kicks off in 1950, and a lot of the Western powers involved in that theater began to restrict supplies of oil to China, and that really galvanized Mao. And the development of an indigenous oil industry then became one of the central goals of the following industrialization process. And part of that, infamously, was the Great Leap Forward. That when that ruthless focus on industrialization undoubtedly contributed to China's, those terrible, terrible famines that they had in the early 1960s. But, China did kickstart the development of an oil industry. And from the end of the 60s to 1978, when Deng Xiaoping, the former Chinese premier, launched its reform and opening up initiative, when China integrated into the global economy, China went from zero crude production effectively to crude production of about 2 million barrels a day. Absolutely astonishing. And in many ways, that was just a taste of the trends to come. So by 1978, China had become the fourth largest oil producer in the world after the US, Saudi, and the USSR. And then, there was talk of it joining OPEC. And that's a really interesting counterfactual, right? Because you have OPEC as the big swing source of supply on the one side, and China as the big swing source of global oil demand on the other. How different things might have been if China had actually joined OPEC.
Where is this oil? This is kind of vastly different from my sort of, heuristic thought of they're completely dependent on foreign sources. Where is this oil produced at this time?
So, they've got a couple of really big oil fields, and they're quite old now. And mainly these are in the northeast, the kind of industrial rust belts of Heilongjiang province, Liaoning province. If you looked at a map of China, Xinjiang's in the west and East Siberia is obviously in the east. If you go east, look at the map of China, on the far east, you get these really cold northern provinces. And that is the source of where most of China's oil is produced. These two big fields, effectively, one is called Daqing and one is called Shengli. And these date back to this industrialization phase. I think this comes back to your initial question, and sorry for taking so long to get to the answer. So Chinese oil demand, following the reform and opening up of the 1980s, China's accession to the WTO in 2001, oil demand really took off. It absolutely rocketed higher as China's manufacturing base expanded and as wealth trickled down from the free trade zones in Guangdong in the south, created an urban middle class. And that's an interesting thing about some of China's leaders, like Deng Xiaoping. They had this view of trickle-down wealth effects from opening up parts of the country, like Guangdong, formerly known as Canton, to international trade, that wealth would percolate from there through to the rest of society. Not sure I'm the first. That sounds like I'm drawing a parallel between Deng Xiaoping and the trickle-down economics of Margaret Thatcher. I guess they were contemporaneous, partly because Deng, he remained at the top of Chinese politics until 1997. So you have this astonishing period of economic growth in China in the 2000s, which is really the high watermark of globalization, when manufacturing, which had shifted east to Japan, got further outsourced to cheaper markets, China, and that drove this astonishing growth in demand. So China was the main driver of oil demand in 2000 to 2019. It accounted for just under half of the increase in global demand in that period, which was a period when its own economy was growing at about 9% a year, if that makes sense. It's a giddy ride through China's oil history.
Yeah, and okay, so let's unpack it a little bit because that's fascinating. Okay, so you've got 2 million barrels a day of domestic production in the early 80s. How, in that sweeping growth, that accelerating growth that we saw during that period, how much, what was their daily demand and how did that rise? What about refining and how were they converting their own crude and foreign crudes? Can you just help us understand sort of that market structure and in the context of the volumes?
Sure. So the initial boost to output, the first 20 years, so we went from 0 to 2 million barrels a day. And then over the next 20 years, so between 1978 and the kind of turn of the millennium, they added another 2 million barrels a day. And it's essentially now a 4 million barrel a day crude producer. But oil demand growth vastly outstripped this as globalization really took hold. And as after China joined the WTO and became integrated into global markets, as it became the manufacturing base for so much of the things that we consume in the West, China required more and more oil to fuel that because, of course, oil is the building block of the entire petrochemical industry. And this is the point, I guess, where I came into the picture, Paul. This was back in July 2008 when crude hit $150 a barrel, and that reflected, I think, in large part, a combination of this preternaturally strong demand for, in particular, diesel from China at a time when OPEC supply restraint had actually tightened the availability of the medium density, the medium API crude grades you need to maximize diesel supply. So I started looking at this market back in 2006. At the time, oil demand in China was 6 to 7 million barrels a day. During the period that I've been looking at it, it's grown by another 10 million barrels per day. So it's now about 16 million barrels per day. It's the world's largest crude importer. It imports over 11 million barrels a day of crude. It's the second largest oil market, as I say, after the United States. And I would say it's also the largest source of marginal demand in the global market, because we're now at a period where that demand growth, that startling demand growth that we saw in the 2010s, is starting to falter and even shrink. And Chinese oil importing companies have, as a result of that, discovered acute price sensitivity, right? So if you think about, as if you're a refiner, where do you make your money? Well, predominantly you would make it from things like gasoline and diesel. And gasoline and diesel would account for between, I don't know, 50, 60% of what you would get out of a refinery. But demand for those products in China is actually shrinking far faster than it is in other markets in the world, which means in turn that Chinese refining margins are now weaker than they are in other markets rather than stronger as they were back in that sort of 2008 heyday. So if you're a Chinese refiner, you're constantly watching these global markets like a hawk because you need to switch between all of these different sources of competing supply. Atlantic Basin, are you buying it from Brazil? Are you buying it from West Africa? Are you buying it from the Middle East? Are you buying it from Russia? Because you really need to optimize costs.
That's the fascinating part of this story, that acute price sensitivity and how that's playing out. And as you say, is serious consequences and opportunities for the world's oil traders. There's a couple of bits more, I enjoy my history and I want to sort of stay on that bit for a second.
Yeah.
Can you just weave in the refining capacity that was built during that heyday? Let's stay in the heyday. And can you also unpack for us a little bit of who are the actors here? You've got the big Chinese national oil companies or state-owned ones, Sinopec, PetroChina, CNPC, and so forth. During this period, they themselves were going out and building global trading capabilities to access some of these crudes to fill that shortfall. But can you, first of all, I guess let's paint the refining picture. Who does it? What is it? Where is it? And then we'll just talk about the actors, and then that will feed into who's feeling that price sensitivity most acutely in this current narrative.
Yeah, no, I mean that's another really, really central part of this whole story, I think, because as you say, China's refining base, the number of refineries that it has expanded actually faster than domestic demand. So China now has effectively an exportable surplus of refined product. But when we think of China, as you say, we think of China Inc. And when we think of China's oil sector, we think of these big state-owned oil giants, CNPC, PetroChina, Sinopec, CNOOC, Sinochem. But these guys control maybe 2/3 to 70% of China's refining sector. China's got about 18.5 million barrels per day of refining capacity. And those state-owned enterprises, those SOEs, control, about 13 million barrels. And the balance of that capacity is these the infamous teapot refineries, which we tend to refer to as independents, right? No one likes to be referred to as a teapot, I think. Also, just, philosophically, when you boil crude oil in a simple refinery, effectively, it's like a tea kettle. So I am not quite sure how we came up with the teapot concept because no one ever boiled anything in a teapot. But there we go. So way back in 1960s again, when Mao sent the People's Liberation Army, and it was a military enterprise to develop those massive Daqing and Shengli oil reserves in Shandong and Liaoning, the government also began allowing local governments to collect and process the oil that leaked out of the pipelines and make some money off the back of that. And this was kind of a sop to the local governments, which had been forced effectively to give up oversight of the large tracts of land on which these oil fields were being drilled and had lost a lot of tax revenue as a part of that. And so that the Shengli field, which even now produces, about 400 kbd, 400,000 barrels a day of crude, it covers an enormous area of land. And it was also quite hard for the officials in charge of that oil field really to monitor and control it. And Eric Downs at Columbia University has done some really fascinating kind of work on the history of this. But as the wealth effect of globalization expanded and Chinese oil demand grew, so too did the profit incentive for these oil companies. So Sinopec, for example, controls most of the gas stations in China, big state-owned company. But its own refineries are also a relatively expensive source of product. If it wants to make more money, and executive KPIs are linked to things like the share price now, it needs to buy product more cheaply, and it can do that from these independent refiners, the teapots. They don't have gas stations in the main, and they need to discount their gasoline, their diesel, so that someone will drive up to the refinery gate and collect it. So Sinopec is perversely incentivized to buy product from competing refineries more cheaply. And that's what gives the teapots their market, because these guys are not allowed access to seaborne markets. They can't just load a cargo of gasoline and ship it out to, say, Singapore. They have to sell it domestically, and it has to price to clear in the local market. So for years, these teapots existed at the margins of the market in a legal grey area, taking oil from the Shengli oil field, or the Daqing oil field, or onshore fields in the Bohai Bay in North China, and buying bits of Russian fuel oil called M100. But then in 2015, they started to go bust. By that time, they were too big to fail. So, like the big global banks in the financial crisis, they were inextricably bound up in the local economy by that point. They've become major employers. Local governments derive a large chunk of their tax revenue in the form of corporate income tax receipts from teapot refineries. But the teapot refinery profits started to contract by 2014, and the amount of tax revenue that they were able to hand over diminished. And that in turn threatened the financial viability of some of these local administrations. So you have, these little, I say little, they're not little, these cities, like Zibo or Guangrao in Shandong. These would be sizable cities by anyone else's measure, but these are quite small cities in China. But if that local refinery, that teapot refinery, that was the main source of employment and of tax for the local governments, they go bust. The local governments go bust, the local administrations go bust, and Beijing has a problem. So the government started handing out these quotas, crude import quotas, that would allow them to go into the global market and buy crude oil directly from the international market. And that's what really unlocked this second great phase of growth in the Chinese oil demand story. So from 2016 to 2020, this was boom time for the teapots. Foreign companies were lining up around the block to sell them crude oil. And you had the majors and the big trading firms, and even some of the big crude producers from, Brazil or Saudi, opening representative offices in Shandong, this little province in North China, to ensure that they got the business from these new internationalized teapots.
And they themselves at the same time were building their own trading capability outfits we were helping some of them in Singapore, right? I mean, they were also sort of themselves getting representative offices in the major trading hubs. Fascinating.
Yeah.
And how complex are these? Can you sort of give us how large is your typical independent, and how complex are their operations? Because that will play into, I guess, how they can try and manage their feedstocks to meet a changing demand in China, particularly around diesel and gasoline. But how complex are these refineries?
That's a crucial question. I mean, I find the teapots endlessly fascinating. I really do. Because we were kind of one of the early movers in terms of really recognizing this market when it started to grow up. And they range in size, they range in scale, they range in complexity. They're very, very hard to pin down. But if you go back to the start, they were simple hydro skimming refineries. They would boil crude into its original kind of fractions. They would get a lot of gas oil and some naphtha and a lot of residue. But as they became wealthier during this period, they started to add more units, become more complex. They started to integrate upstream and downstream a little bit more, and they began to look like kind of serious oil companies. And a lot of them are absolutely properly serious oil companies. These are not necessarily small concerns at all. They would range in size from, say, 250,000 barrels a day of CDU capacity, and that is decent. That's about the kind of average size of a refinery in Europe, down to very, very small ones. So some of them are literally 2,000 barrels a day, and the government really wants to shut these tiny ones down, but it's very hard to do.
Fascinating. And this kind of plays into this, you alluded to it there, the opacity of this market, and how do you go about, and obviously you've been doing that coming up to 20 years, the expertise you need to understand what's going on locally, and how do you get that insight? And then secondly, can you also, you know, allied to that question is, are there indexes in China? How does pricing work? How does that all sort of piece together? Are there exchanges? And I know these might sound really naive questions to someone, but if I'm a independent, how do I work out how I'm doing against my competitors? What price I should be selling at, etc.
Well, I'm very glad you asked me that, Paul, because
It wasn't.
we are those guys. No, it was a really interesting time, when China deregulated crude imports and it allowed them to begin importing crude. For us, as a price reporting agency, suddenly meant that for the first time we had an insight into how much Chinese companies were prepared to pay for crude, right? So in most markets, you have a price at loading, like in the North Sea or in the US Gulf, and you can calculate how much it would cost to send that crude to China, but you do not know how much refiners in China are actually prepared to pay for it. So for the first time when this market developed, and we were fortunate because we've been watching this space to be very much at the forefront of quantifying it at Argus, we were able to see exactly how much value a refiner in China is prepared to assign to the value of a barrel of crude oil, and whether those arbitrages were open from the producer countries. And you mentioned that various of the independents had set up representative offices in Singapore, and they did. And there's some really serious guys down there like Dongming and people like that. Absolutely serious companies. A lot of them, however, I think those were probably the exception to that rule. So the independent refiners, don't forget, had been bottled up inside China. They'd begun life as owned by the local administration. They didn't know how to go into the North Sea physical market and bid for spot cargoes and, play with the forward market and all that kind of stuff and put a VLCC together off Helm Point in the North Sea or whatever. They bought everything delivered. They were just like, I'm in Shandong. How about you get the crude to me and I'll just pay for it? So the pricing that we saw develop there, it's still known as the kind of the DES market, which is an Incoterm, which meant delivered ex ship. They are onshore concerns primarily. They will take ownership of the crude oil that is supplied to them at the point that it kind of makes landfall. They don't really have a lot to do with the shipping, with the procurement in the global market. And that, I think, that was a really interesting trend for us. The heyday of the teapots is kind of over now, and it's all about the state. And of course, that gels very neatly with Xi Jinping's broader economic vision. It's all about Fortress China now, insulating the economy for the trade war to come with the US. And that, of course, requires in China, at any rate, massive levels of state control. But we have now built up this understanding of the Chinese market. And it's really just the nature of the buyer that's changed. It's not that we've lost sight now of what's going on and what the price of crude is in China. So that has definitely, from our perspective, been a real eye-opener, a real game changer.
Yeah, fascinating. Okay, so let's I've got a good understanding of kind of the setup, if you'd like. So can you just tell us, there's the three big events of the last 5 years have obviously been Russia's invasion of Ukraine and subsequent sanctions, electrification and EVs, and that story is particularly powerful in China, where we're starting to see that we've seen peak gasoline arguably, and then of course COVID. What happened? What happened to demand in COVID? Can you sort of weave together a bit of the last couple of years, and then we can bring it up to this point of today, and how China is sort of right there as central in crude pricing, and how it's adopting to this more fragmented market, but also a market with more opportunities with Latin America coming on and so forth.
I mean, the last few years have been quite
eventful,
traumatic for everybody.
Yeah.
I think it's fair to say,
enough, yeah.
But they were absolutely, there was systemic structural change to the oil industry in China, and I mean, just to think about this from the prism of the teapot refineries. The teapot refineries, in many ways, they are the canary in the coal mine. They are the butterfly that flaps its wings and causes a hurricane on the other side of the world. These are small companies with poor cash flow and high borrowing costs. So COVID for them was existential. you got a massive demand shock, of course. You also start to get major pushback from the state-owned enterprises against the independent sector, especially from Sinopec, which is China's largest refiner with about 5.5 million barrels a day of refining capacity. It had lost a lot of market share to these impudent little upstarts. Regulation kind of begins to swing back the other way against the teapots. The companies that had sold them imported crude in excess of their government allocated quotas got slammed. What's really been problematic for them, though, was the tax audits. And again, because national tax revenues shrank during the pandemic, and China, unlike the US or countries in Europe, didn't go in for QE. So the fiscal balance was severely straitened. When the going was good, Beijing could afford to turn a blind eye to pretty egregious levels of tax avoidance being practiced out of Shandong. When the going was bad, Beijing could no longer afford to do that, and it started to come down on them pretty hard. So massive back tax fines, and we are talking billions of yuan. But yeah, and that also kind of played into the opacity of the market, because China it's more mysterious, I would say, than opaque. It's opaque in a different way from the United States. In some ways, the market's more transparent, but at an official level, it's actually becoming, at a macro level, harder and harder to work out what's going on. GDP data increasingly sensitive. Energy data, strangely, becoming more reliable. So a lot of the energy data in China is compiled on the basis of tax returns. So when the teapots were the driving force behind oil demand growth in China, you naturally got huge underreporting of oil demand because they were like, hey, I'm not going to tell you how much highly taxed diesel I produced last month. So with their role now shrinking and these rolling punitive tax audits running through the sector, in an odd way, oil data in China is becoming more reliable. And of course, that's important for Beijing to know for many reasons, right? You can tax it and you're far more aware of your strategic pinch points because it's very hard, for example, for the government to organize a strategic petroleum reserve if it can't quantify oil demand.
Just to understand that just for a second, sorry. Just make sure because it's a bit chicken and the egg here. Did the crackdown on the independents happen as a result of the tax avoidance, the lost revenue, China suffering economically during COVID and needing to get those tax receipts in, or did it happen as a result of sort of central policy to get more control back over industry? The Xi's big crackdown on corruption. What's the genesis of this?
I would say it was the former primarily rather than the latter. There were shots across the bows of the independents when Sinopec started to get kind of upset with how much market share they were taking. But the turning point absolutely, I think, came with it followed COVID and the crisis in kind of, fiscal income with tax receipts, that the levels of tax evasion that were going on were rampant. So if you were to look at a chart of Chinese diesel output from the refineries from, say, 1990 to 2016, it goes up steadily, 4% a year. And then from 2016 through to 2023, there's a dip. And that dip is essentially the omission of diesel output being reported. And it's an absolutely large chunk taken out of the national balance. That diesel was produced, but it was not reported to the tax authorities. And that in part, the independents are not fighting on a level playing field necessarily. The regulatory environment is skewed against them. The banks will lend to state-owned companies far more cheaply than they will lend to these teapots.
So they're getting taxed in other ways in some ways. So it's a market response. Yeah.
They claw that back where they can.
Okay, so fantastic. Okay, so and then I interrupted you. Sorry. So we've had COVID. You've had this.
No, well, a lot of things happen simultaneously, right? So going into the pandemic, we had the first Trump administration, the trade war, and that exposed some key dependencies in China, dependence on imported raw commodities, including oil, but chiefly ags. It also highlighted the areas where China excelled and had key strategic strengths like renewables and EV manufacturing. So Beijing decided to double down on both of those things. And, kind of going back to the trade war and the trade deal, of course, China had said it would import, what was it, $200 billion of US commodities to mitigate the trade surplus. But it never did buy that stuff because the pandemic hit. China, and the whole COVID period was a dark and fascinating one in China, because it locked down after the initial outbreak in 2020 very rapidly. But by the end of that year, was actually able to unlock, at least within closed borders. China's economy started to grow really strongly in late 2020 and throughout 2021. And the central government, looking at all these ailing Western economies, I think, I don't want to psychologize the Chinese government, but I think it began to believe that it could sort of walk on water and see through walls. The weak West was still locked down, but China had achieved a victory over the virus. It was firing on all cylinders, supplying PPE from its massive petrochemical manufacturing base to the rest of the world, except, of course, it had won a battle, but it hadn't won the war. And, then Omicron struck. At the same time, the government decided that late 2020 was the moment to pull the plug on the massive Ponzi scheme that was the real estate sector, which by that point accounted for a quarter of GDP. So that was when they banned banks from lending to over-leveraged construction firms, which then stopped building the apartment blocks that they'd actually pre-sold to a lot of would-be home buyers. And bear in mind at this point that the value of apartments had risen steadily. It had actually, massively outperformed returns from the stock market. It was a key store of wealth for the middle classes. And it underpinned a lot of what was going on in heavy industry and manufacturing in the oil industry. So when Omicron struck, you had the real estate crisis, diesel demand kind of collapsed. And I say that China never did QE in the way that we did. And that wasn't because, that was because it had, I don't know if you cast your mind back to the financial crisis, it had unleashed a massive economic stimulus to counter the effects of that, right?
Yeah.
That was ostensibly worth 4 trillion yuan, which is about $600 billion.
Yeah.
But it metastasized due to the miracles of fractional reserve banking and these things called local government finance vehicles into something that was worth more in the region of 40 trillion yuan and left a lot of local governments saddled with unmanageable
this is what Michael
levels
Pettis
of debt.
has been talking about since like 2012, right? I mean, sort of how leveraged this economy is. And as you say, the linchpin being real estate that essentially got popped, at the same time as COVID. And at the same time as well, for this story, you had that foresighted and long-sighted plan around the energy transition because of their dependence, highlighted by the Trump administration in the first term. And so at the same time, you started to see, not only people weren't traveling because of COVID, but when they were traveling, we started to see the rise of EVs.
Yeah, it was a sort of trifecta of trauma for the oil industry in China. So exactly. So all this construction stopped, and a lot of governments were left with these kind of white elephant construction projects, build bridges to nowhere, ghost cities. But it was that experience from the financial crisis, I think, that really, it was quite sort of psychologically scarring, I guess, for policymakers in China, because that's really why we've seen this pretty tepid response to the slowdown that's going on now, because it's already got massive debt levels. It's already struggling to kind of deal with that. But yeah, so that was the turning point in oil demand. That was when oil demand stopped growing, and it was a kind of a truism in the oil market that Chinese oil demand would grow by 500,000 barrels a day each year. And that is now no longer the case. Like, oil demand shrank by 350 kbd last year, and it'll probably be kind of flattish this year.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global experts network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project. at encoinsights.com.
And so where are we now in terms of that oil demand? And let's lean into that. The belief is we've seen peak oil, right? Construction is probably going to slow down, but crucially, the reality is that the energy transition is beginning to bite. And, I just had an episode with Jan Reistad talking about sort of actually China following kind of Norway, and you suddenly start seeing this tipping point of 18% drop in gasoline demand each year is kind of you get this tipping point in EVs. But can you, I don't want to sort of jump the gun, but can you just give us some sense of it now?
It's been absolutely mind-boggling, and again, it plays into China's strategic strengths, right? So this intense competition, in particular with the United States, is one of the things that has almost undoubtedly prompted China to double down on EVs and renewable manufacturing like wind turbines, solar panels. They control the processes, right? You need half a ton of raw earths per megawatt of turbine capacity. Each EV requires about 5 kilograms of these things like cerium and yttrium. And China owns all the rare earth manufacturing capacity, like 90% of rare earth manufacturing capacity. Strategically, if your nemesis is the world's largest crude producer, which the US is, then as China, you want to minimize your dependency there. And so, yeah, we've seen this astonishing rollout of EVs in China, ruthless competition at a grassroots level between EV manufacturers in China. So we've got to the point now in China where EVs are comparable on cost with a gasoline car, but your running cost for that EV is about 10% of that of a gasoline car. It's a no-brainer. And we see this in the gasoline data, right? We reckon based on charging data that Chinese gasoline demand would have been 500,000 barrels per day higher if China hadn't expanded its EV fleet so aggressively in recent years. And of course, by extension, its dependence on crude oil imports would have been that much greater. In fact, one of the and this blew my mind, but it's just insane, right? One of the major challenges that EV drivers in China face is not finding a charging point. It is not range anxiety as it is in most of the rest of the world. It's that the firm that sold you the car may have gone bust in 6 months, and that the operating system won't update, and the doors won't unlock because there is a newer, faster, more efficient, larger scale company that has taken its place. It's quite crazy there, in terms of EV manufacturing, but it has a massive effect, on gasoline demand.
Yeah, that's fascinating. So I guess I guess I'd like to hear that story actually. And so this is an incredible number of new startups in EV production and so forth. I mean, how can you give us some sense of scale of that penetration? And just how far ahead in some ways they are than what we're seeing elsewhere.
I mean, they are. It is genuinely impressive what they're doing in EVs. I mean, I was in Beijing late last year, and the quality of the cars. You're being kind of driven around in something that feels like a very expensive saloon, but would probably have cost, I don't know, sort of $30,000 or something like that. It's astonishing. The other trend that we've really started to kind of notice is, so you have the battery electric vehicles, BEVs, you have the plug-in hybrids, and you have these models with so-called range extender EVs, EREVs, and those started to grow very strongly last year, sales of these. To the point that what China collectively refers to them all as new energy vehicles. They were by the end of last year accounting for more than half of new vehicle sales. So the traditional internal combustion engine vehicle fleet was really being kind of chipped away. The replacement ratio was well below 1 there. But yeah, so these EREVs, these range extenders, and that there you've got a small gasoline engine keeping a battery charged. And these boast, and I've not road tested them, Paul, I cannot vouch for the efficacy of these claims, but they claim that, something like 10,000 miles on a charge. That's nuts. That's crazy. The only thing is, of course, those EREVs are still quite pricey. And as long as Chinese purchasing power, household spending power remains relatively constrained, which it does, I think when you try and sell these kind of high-end EREVs, it's quite a tough sell. So we've sort of seen sales switching back towards plug-in hybrids, which are a bit cheaper, but of course that will slow the transition away from gasoline because a plug-in hybrid consumes more gasoline than an EREV hybrid.
That's the narrative that then sits up this declining gasoline and diesel demand, these reducing margins that these refineries, whether they're the independents or not, are seeing in China, and therefore this need to be razor-like focused on finding cheaper crudes. And that crude supply picture has changed as well in the wake of sanctions, but also new suppliers coming on from the likes of, Argentina, etc., Brazil, obviously. But tell us about that picture. Like, what are we actually seeing, and what can it tell us about crude pricing and China becoming kind of that marginal barrel?
I mean, that I find this as a kind of analyst of oil markets really, really fascinating. The way that China and Chinese companies optimize around this, because these are big global companies. I'm thinking here about the state-owned companies. Your Sinopec, PetroChina's, CNOOC, Sinochem, big global. They have upstream. They all around the world. There was a period in the kind of 2000s when they went around the world buying all these upstream assets. So they have stuff in UAE. They have stuff in offshore Brazil. They even have stuff in the United States, the shale patch up in Canada. They got stuff everywhere. They've got storage, and they've got these global trading operations. So if you're a Chinese refiner, it's kind of interesting because, of course, China's at the far end of a very, very long global crude oil supply chain. So quite often, crude will arrive in China, say, 100 days after it trades in the market. So you would be buying crude now for delivery to China in June. And you can buy some of your crude and it'll arrive in June, and you can say, oh, well, I know what the price of that June cargo is. But then not all crude that you can buy will arrive in the market in June, right? Some will trade what we say, as we call, more promptly. So we call these trade cycle differentials. So right now you could buy a cargo of crude oil from Brazil and it'll arrive in China in June. You could buy a cargo of crude oil from Angola and it'll arrive in May, or you could buy a cargo of crude oil from Russia and it'll arrive in April. So as a refiner, when you're making your procurement decisions, you have to say, oh, well, I know what the price of this June cargo is from Brazil. I do not yet know what the price of Russian crude will be in June. So I will buy some Brazilian crude, but I'll keep back a portion of my refinery requirements for the Russian crude, which trades more promptly. And I won't know what the price of that crude is for another 2 months, maybe. But I will bank on the fact that it is going to be cheaper than anything else. So I will kind of play these different supply sources off against each other. And this, for me, has been one of the ways that we've really seen Chinese oil trading develop in the last few years. As oil demand growth started to falter, as refinery margins started to underperform global peers, Chinese trading companies have had to become far, far more agile in terms of how they optimize between different crude oil costs from different supply sources.
Yeah, and just to be, this might be naive, but are we also, what's their capacity, facility, ability to trade and to hedge this, essentially playing supply on hard mode, given their location and so forth? Are we seeing them also participating in the derivatives markets to try and hedge this complexity, or do they not have, they don't have that capability?
No, they absolutely do. I mean, that was one of the things where I think, with the teapots struggled, and they had a very different way of buying crude, that not many of them were actually registered with futures exchanges. And even, when you're thinking about swap markets, so, if you were to trade a dated to frontline swap which would hedge the difference between the physical North Sea dated marker and an ICE Brent future. That would clear through an exchange. If you were going to hedge a Brent Dubai EFS, that would clear through an exchange. If you're not registered with an exchange, it's very, very hard to do that kind of swap trading. But the state-owned companies, absolutely, they are all over that, and they will regularly take different positions in the Brent market. They might say, oh, well, we think that Brent prices are going to go up, so we're going to go long Brent. We think that Dubai prices are going to fall relative to Brent. We're going to go short Dubai, things like that. And they can absolutely play around with that. They're also, of course, very engaged in even, the hedging of WTI trade on, exchanges like the CME in the United States. They are absolutely comprehensively upstream, downstream, hedged, everything really. They're very global.
Yeah, we've certainly seen that, the likes of PetroChina and Sinopec, of course. What the other lens, of course, here as well is that with Xi, you've got increased, the state control and oversight. Are there periods we see that the economics don't apply because China wants to buy for Russia for geopolitical reasons, for example? Is that weave into that narrative at all, or is this very much, about the economics?
No, the economics are central, I would say. I think that was one of the reasons why the Trump trade deal with China failed, really, is that if you look at something like WTI, it is simply not the most economical source of supply into China. And so that's one of the reasons why China put a 10% tariff on US crude imports in this latest round of the trade war, right? It doesn't care. It's not like it's a baseload source of supply. China's never been a massive importer of US crude. At a very basic level, diesel represents the main product that Chinese are kind of geared to produce. And WTI, which is the largest US export stream, is a bad feedstock for diesel because you can't really upgrade it. It's too light. And that's even before you factor in the strategic concerns around US-China relations. Typically, if you want a light crude in Asia, you would and not necessarily thinking about China now, but Asia more broadly, you would look at the relative costs of WTI with another light crude like Murban out of the UAE in Middle East. So last year, the UAE started exporting a lot more Murban, which meant that it was cheap. And also, it doesn't sail as far. Right, it's only got to sail 20 days to get to Asia, whereas WTI has got to sail about sort of 60 days. So you have far longer voyage times and actually far higher costs. You didn't see a lot of WTI arbing into Asia last year. So yeah, in that regard, the reciprocal 10% tariff that China put on US crude, they did that because they could afford to. They didn't tariff anything they genuinely needed from the US, or like LPG, which is absolutely vital to China's petrochemical manufacturing base. And the petrochemical thing, that is very important in China, and it's increasingly so. But, in terms of if they want a light crude, there are cheaper grades available. In terms of sanctioned crudes, and I'm thinking here Russia and Iran, right? So in the West, we have self-sanctioned Russian crude because of the invasion of Ukraine, and that has been very difficult for refiners in Europe because it meant that they were built to run Urals crude, and now they can't do that, so they've got to substitute it with things like Brazilian and US crude. China, they always ran a lot of Russian crude. They've got a big pipeline called the Espo pipeline, which again comes into those northeastern provinces that I mentioned, Heilongjiang. So the Espo pipeline carries 600,000 barrels a day of Russian Espo blend crude directly to PetroChina refineries. There's another 1 million barrels a day of Espo blend that comes out just north of Shandong province, like 5 sailing days from Shandong province. And that 1 million barrels a day of Russian Espo blend, that its natural home is China. It's the perfect crude for China, and no one else is buying it now. So it's kind of economics. If you look at the price of Espo blend versus the price of a crude like Brazilian tupi, with which Espo blend used to compete before the war, Espo blend for the last 2 years would have been, I don't know, $5 to $8 a barrel cheaper than tupi. Currently, it's around $2 cheaper than 2p, but that's still a significant advantage. And so you'd be like, if I can buy Espo blend, I will buy Espo blend. The state-owned companies in China, though, and I think this is worth stressing, they are very sanctions wary. So they wouldn't, if like Sinopec does not process Iranian crude, right? The Iranian crude that we see going into China, again, it's going to the teapot, it's going to Shandong, and that's really a measure of how tough their lives have become since COVID, when their margins are being squeezed so aggressively by aggressive fuel substitution in the road fuel market, EVs, right? They would gravitate towards the cheapest feedstock around to control costs, and that tends to be Iranian. So Iranian crude is now trading about $5 a barrel below comparable quality unsanctioned crude. So if you're a Shandong refiner, maybe this means giving up your chances of a green card, but that seems to be a price that they're willing to pay in order to sustain their businesses.
Yeah, this is leeriness about being caught up with sanctions and thus losing your access to be able to trade in dollars and so forth for those large state-owned companies. In a way, has the EV flip or tipping point been somewhat delayed because of Russia's invasion of Ukraine, and that you have had this source of cheaper barrels that typically in a normal world without these sanctions, they would have been, we would have seen overall, they would have competed with everyone else on a level playing field?
That's a really interesting counterfactual. And I think you're almost certainly right. To a certain extent, yes, because China and India too do benefit from their continued access to relatively cheap Russian crude. The thing I would say about China though is oil taxes are very high. So if a change in the wholesale price in the United States would translate kind of, maybe not one for one, but there would be an obvious impact on the price at the pump, right? If the crude price falls, it's cheaper gasoline. In China, that's not necessarily the case because the market's so heavily taxed. If you think about the final cost of a barrel of gasoline, about 50 or 60% of that is tax in China. So that does blunt the effect of the relatively low cost of sanctioned crude. Any advantage there, I think, will have been accrued to the refiners. And that's something that they kind of really need because, of course, oil demand, particularly for transport fuels, is shrinking quite aggressively. And they are struggling to compete on cost with their competitors in markets like India, where demand is growing more strongly.
Yeah. Fascinating. Final question, and it's been really good. And you and I met at the Argus Crude conference, and I watched your fascinating presentation that has lots of amazing graphs that I barely understood, but underpins all your deep knowledge on this. So I'm sorry for being slightly superficial.
I do love a graph.
But if I'm a global oil trader today, or I say a Western oil major that's building a trading capability, do I need to pay more attention to China today than I did 5 years ago or 10 years ago or less?
I would say more. And I'm not just saying that because I'm the China guy. No, I genuinely do. So if we cast our minds back again to the kind of teapot heyday, the independent refiner heyday, when Shandong hit the market in, say, 2015 to 2019, one of the complaints at the time, particularly from other refiners in China, again, Sinopec, was that they were effectively driving up the price of crude oil because they would just go, I don't care, just bring it to Shandong and unload it and I'll just pay you what you want. And that their role in the market, was said to be kind of inflationary at the margin. So they're kind of gone now. They're buying mainly Iranian and Russian crude. What you're left with is these state-owned companies who are acutely price sensitive and acutely seriously experienced and globalized traders who will switch back and forth between markets. And China's sheer scale means that when they do pivot from one market to another, it will have a profound effect on price. Or, they will switch back and forth because of a change in price. So when the Biden administration imposed sanctions on Russia on January 10, suddenly you basically made it almost impossible for people in China and India to buy Russian crude, and you got suddenly Indian and Chinese refiners all piling into the closest alternative market, which was the market in the Middle East. So then you have this astonishing jump up in the cost of the Dubai crude benchmark relative to, which is a sort of sour benchmark in the Middle East, relative to the ICE Brent benchmark and the dated benchmark, which is the sweet benchmark in the North Sea. And so the changes in buying patterns have these profound effects on the reference prices used to set crude globally. So if suddenly China decides to shift from the Middle Eastern market back into the Atlantic Basin market, a lot of the pressure on the sour crude market recedes and it transfers into the sweet crude market. That would have an impact on what we call sweet sour spreads in the crude market. You'll see the cost of sweet crude rise relative to sour crude. And that would have a knock-on effect on things like the structure of the market, the premium of the prompt to the forward price. It'll have an impact on the relative cost of different grades of crude oil because they all trade at little differentials to these market prices. Will Chinese buying of Brazilian crude make Brazilian crude expensive relative to crude from Oman or stuff like this? No, it is absolutely, I think, central and maybe even more important now to understand what is happening in the Chinese market than it was back in the boom time of the sort of late 2010s, early 2020s.
Well, Tom, it's been an absolute joy having you on, and I hope we can have you back on in a year or two to get an update on, a fascinating lens on this story and some deep insight there for people, for market participants. I guess, where can people find you and see your work?
By all means, check us out on Argus Media. We have a website. You can get all our stuff there. I'm on LinkedIn if anyone wants to drop me a line there. And yeah, Argus Crude conferences. So we'll be going down to Rio, which is a really exciting growth supply market and a very fun conference to come along to. Rio is really nice.
Yeah. Our office is in Sao Paulo, sadly, but guys and girls get to Rio a lot. So
yeah. So come along in May. See us at the Crude conference in Rio, and anytime you're passing through London.
All right, well, Tom, absolute pleasure to have you on, and look forward to future conversations.
It's been great. Thanks so much for having me, Paul.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.